And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is Dryden Pence, who's the CIO of Pence Capital Management, Pence Wealth Management, and Pence Financial Group. Dryden, thank you so much for coming to the show and welcome.
Happy to be here. This is going to be a lot of fun. I'm looking forward to it.
Likewise. So, Dryden, before we dive in, I want to thank you very much from the bottom of my heart for your service. I know you have a storied career. So, please, my first question is tell us a little about your story and how you got to where you are today.
Well, first of all, I want to thank you for paying your taxes. I think that anytime someone says thank you for your service, my response is, listen, thank you for paying your taxes. I don't think anybody ever really does that for anybody, but I'm a full colonel in the Army. I guess I can do that. But the real point is that, you know, my daughter has a daddy because somebody paid their taxes. Because I've been to war a couple of times. I've had Humvee. You bought me a armor-plated Humvee, and it got blown up underneath me. I've had body armor that has got shrapnel in it. So the point of the matter is I'm alive today because some U.S. citizen paid their taxes, and I think we have to thank everybody because you guys buy the body armor that keeps soldiers safe. So next time somebody has to painfully write that check, just recognize you're sending parents home to their kids by doing
That is
that.
so
So
powerful. That
thank
is
you.
so, thank you. No, that is absolutely fantastic. So the
And
story, how'd you get to where you are, please?
how did I get to that place?
Yeah.
So I grew up in a small town in Arkansas, Fort Smith, Arkansas. Dad was kind of a country doctor. I ended up applying to Harvard on a whim, and I got in. And majored in economics. And while I was there, I got recruited into the intelligence community. I did ROTC at MIT because Harvard didn't have it at the time, and then went into the military and got tasked into Army Special Operations, where my expertise became psychological warfare,
Oh, wow.
uh, which was a very and that helped really shape everything about my life because we use many of the principles that I've learned in psychological warfare in trying to understand markets and trying to understand human behavior and how it affects things. So that blending of economics and psychological warfare background really comes together in everything we do. So that's kind of brought me to that. I ended up in investment banking for a while, then married my current wife. We have the financial planning practice of Pence Wealth Management. Grew up through that, so she's a quite accomplished financial planner. She's on all the awards list and things like that. So she handles the planning side, right, and then I worry about the investment and the marketing side, and our teams are built that way.
Wow, I love that. So I'm a big psychology fan as well. We just met right now. It's our first time meeting. I wrote a book. It's called Psychological Analysis, which is a third school of thought, fundamental, technical, and then psychological is my contribution. It was number one on Amazon for 2 months. So I'm really interested in what you're going to share here with my next question. If you can tell us a little about your investment process. I know you have your own investment strategy called Chokepoint Investing.
Exactly.
I'm going to be taking notes. So by all means.
Well, so when you think about our investment process, I think in any process you have to have principles, and you have to have a process. So I'll talk about the process. The fundamental thing that we think about initially is that human behavior drives consumption.
Right.
Nobody makes a penny until someone decides to buy. And so,
Correct.
since you have a background in psychology, you can recognize if we can get into the decision making process of the American consumer, we can be predictive about not only what they're going to buy, but when they're going to buy it and who they're going to buy it from. So
Okay.
we look for the big knowable themes that are driving consumer behavior. And then we do a thing called choke point analysis. So look for big noble themes, identify the choke points. And a choke point, that's a military term. It stands for a point in place in time where everything has to go through the choke point to get from where it is to where it wants to be. And if you look at the supply chain of satisfaction of human demand, and almost any supply chain, you identify these choke points. It's like a bridge across a river. You want to get to the other side, you got to go across the bridge. The
Right.
guy that owns the bridge can charge you a toll and you'll pay it. So
Yeah.
companies that control the choke point tend to have pricing power, like a little monopoly or oligopoly. That pricing power turns into excess earnings. excess earnings then drives better performance of stocks. It's really not more complicated than that, but it's a discipline that one has to exercise ruthlessly. And I think that that's kind of our general process. Look for big noble themes, identify the choke point, target best of class, figure out how we're going to capture the cash flow because those companies have excess earnings, and that
Yep.
turns into better performance of a portfolio.
I love that. And then as far as entries, exits, the next question is going to be risk. So how do you handle risk management and what are some mistakes you see people make with respect to risk management, please?
Well, on the risk management side of it, the first thing you have to ask, so let's say we've decided, we've identified a big noble thing driving people to do stuff. We can come back to Maslow's hierarchy of needs at some point if you like. But then once we identified the choke point and those things, our risk management comes from asking a couple of questions. Every time we look at the portfolio, we go, is there something wrong with the big knowable theme, right? Or is that still intact? If that's not intact, then we need to go somewhere else. Is there something wrong with the choke point? Because sometimes, a company that's a first mover controls a choke point, but then after a while, everybody gets in and that's all disintermediated, and there's no longer a choke point. So there's no longer this ability for pricing power. And then is there something wrong with the company itself, right? A marginally run company can still make pretty darn good profits if the theme's right and the choke point's right. So we put that as the third question because we generally stipulate that boards of directors sort of know what they're doing and management is reasonably competent. And so that's kind of the third on the list. But we start with the behavior because in the end, nobody makes a penny till someone decides to buy.
Oh, 100%. So you look for earnings deceleration or as far as knowing whether the thesis is busted or not, so to speak. When do you know that, hey, this noble cause is no longer valid? Is it price action? In other words, a stock falls X% below your entry, or is it earnings slowing down, a combination thereof? Or if you can give us some examples to quantify that, please.
Sure. We're going to focus first on earnings. That's going to be the first indication because human emotion can drive the multiple a lot, right? And we can talk about that further if you like. But when you get into this, the multiple can be moved around by all sorts of externalities that have nothing to do with the big noble theme or the choke point. And so those are more sometimes short-term aspects, whereas the long-term thing is really what's the potential for this product or this behavior to generate earnings for these companies over a long period of time. And so we try to avoid excess trading. We try to avoid bouncing around so much because if you bounce around a lot, you tend to have more opportunities for mistakes. I've always in the military I learned to always look for single points of failure, right? And you want to be very careful about that.
So when you look at risk management, are you looking at an overall portfolio or do you take it from position to, because we have a lot of professional investors and money managers and their clients that watch the show and they're looking for, I guess, specifics. Do you look at overall portfolio and look at risk that way, or you wait for earnings? Let's say a stock falls 70 or 60% or 30%, and then the earnings slowly slow down afterwards. How do you handle that situation? And then when do you exit? Do you just arbitrarily sell it? If the stock drops a lot, you'll buy more on the way down, or how do you handle those?
Sure. So first of all, every position has to fight for its position, right? And every position has to fight for its position. So some portfolios we look at quarterly, some we look at semi-annually, and we look at what's going on macro. So we're looking at the individual holdings level. So there are some times where there are sectors where we probably will have very, very little holdings in them if we think, or we'll increase sectors that we think had the wind at their back, right, at certain particular times. But every holding has to fight for its position every time. And we do that by trying to figure out what's going to drive earnings. And that's really the main component that we're looking at. So how's that going to be effective? And is the circumstance around the earnings, let's say if you see earnings going down,
Right.
is the circumstances around the earnings a permanent thing or a temporary event? And is there value at that moment in getting out, planning to get back in? Or are we at this moment where the price of the stock has become so high, it's way ahead of itself, maybe it's time to take a few chips off the table. You don't get rid of it, but you go ahead and take, it's a basic principle, right? To make profits, you got to take profits, and take losses while they're small. Don't wait for them to grow. And I think that that's just you're trying to get in a very simple fashion is what we try to do.
No, I love that. So to make profits, you have to take profits, right? I like that. And then keep your losses small. So that's where I was kind of going there. So you keep your losses small, let the winners run, and then when it's time to sell, you sell, because you don't want to have that big position reverse on you type of scenario.
You know, it's kind of like a roller coaster, right? You're going to go up and you're going to go down. You're going to go up and you're going to go down. It's probably good to pay attention and take a few chips off the table. And you don't get it right every time. Sometimes you're up 20 or 30% and you go, okay, we're going to take half this off, and the darn thing doubles again, and you go, I wish I'd had that position. But other times you're glad that you haven't been hurt as bad.
I love that. So it's almost like you're treating, if I understand this correctly, and I'm going to apologize in advance for this military analogy that I'm probably going to mess up here, but you treat the positions as soldiers. And then if one gets wounded, you'd want to take them off the field, let them rest or get over, and then make sure your healthy soldiers are on the front lines. Is that a good way of explaining it?
I've never thought about it that way, but I think that's brilliant. I mean,
okay, thank you.
So no, I think it is true, in that you really want your best players at the front end
Right.
of the battle. And sometimes, and if you think about it from a battle analogy, sometimes people need to come off the front line and rest for a little bit
Right.
before they go back. So maybe I'll use that in the future.
Yeah. Send me the royalty. All right. Next question for you. I'm going to shift gears a little bit with you, Dryden, and talk about some timeless advice. So, a man with your wisdom, your experience, your expertise, I'd love to know some timeless lessons you've learned along the way, either in the market, in life, in business, anywhere you want to go.
So I'm very, very fortunate. When I was growing up, our next door neighbor was a Fortune 100 CEO.
Oh, wow.
And he had a cattle ranch. And I got to sit down with him, and he was talking about things, and and I'm a very young man and getting into this, and he sat down, and the story, I mean, it's timeless. We're sitting there on a you can imagine an older man and a young boy sitting on a split rail fence, and we're looking at a herd of cattle. And he says, I want to give you some advice about investing. And he said, if you take a look at those cows out there, if you put a bull with a bunch of cows, pretty soon you're going to have more cows.
Right.
He says, what you got to remember is that God and nature are long.
Mm-hmm.
And so our economy, our government, the freedoms that we have in this country, all of those things are set up in a capitalist system that has worked for a long time. And if you let the system work, it tends to create greater earnings, greater profits, and greater standard of living for all the people around. And so I think sometimes we try to control too much.
Right.
And what we really need to do is recognize that really the world is set up for growth.
Yes.
And set up for getting better, not worse. And I think that's a good piece of advice, that sun's going to come up tomorrow, and things will probably be better. And if you put that as the underpinning of your life, I think that helps both in life and in investing. God and nature are along.
I think that's brilliant. That's next level brilliant. So Warren Buffett talks about the American tailwind, and he gives credit to his success if you read his annual letters, which I do. And in my book, I call it the Great American Tailwind. And what you're doing in your investment strategy, to go back to that for a second, Dryden, which I've noticed in my own observations as well in the last several decades, is this is the term called arbitrage. For the listeners that don't understand, there's a difference between two prices, like gold and then gold stock. So I've got two forms of my own arbitrage. I call it intellectual arbitrage and then time arbitrage. Intellectual arbitrage, be smarter than who you were 10 years ago. And what are you doing today to become smarter tomorrow? That's simple. And then outsmart the competition as well. But by understanding behavior and making rational decisions, not emotional decisions, which is the core part of what you do, and it's the whole point of my book. But the time arbitrage component, and I love what you said earlier, just rang a bell as you were speaking about go long, is where most people are too myopic. They look at every tick or they look at every day, and most days don't matter. And what you're doing is, by definition, or the way you created your investment system, if I understand this correctly, you're taking out the noise of daily movements. You've got protection in place to make sure those losses don't get big, but you're looking at it quarterly or semi-annually, where you're giving that, you plant the seed, you give it time to grow, so to speak, and capture the great American tailwind along the way, which I think is next level genius.
Yeah, I think when you think about, most people are saving for retirement.
Mhm.
Uh, and when you're thinking about something as important as the rest of your life,
Yeah,
and you're trying to make decisions in a few seconds on, do I'm getting this exact price right? I mean, if you have to make an important decision like the rest of your life, the chances of you getting it right in a 30-second or a 5-minute window, yeah, probably not. Yeah, and so I think that I mean, here's the question: do you know any irrational people? And
you're talking about
right, we're
right,
all human
of course,
by our very nature. Human beings are irrational, and
100%.
and when you're put under pressure, or you put yourself under pressure, you create a lot of self-fulfilling prophecies. You shoot yourself in the foot a lot. You put unrealistic, artificial time limits upon yourself, trying to force yourself to be right all the time. And
Right.
we're just not. And
Yeah.
so I think broadening that out, and that's why we look at big knowable themes, right? There's what people do, and there's what governments do. You have people and policy. And so we look at those two things: human behavior or governmental policy that's pushing great big things to happen. That's where money's going to go.
Yeah, 100%. That is so powerful. Okay, next question. Timeless mistakes. What are some timeless mistakes you've made or you see people make, and how do you avoid them?
So I think getting caught up in, and you know, this may be a little heresy for some of your audience, but getting caught up in a trading mentality. Sometimes you have to let the battle come to you.
Right.
And sometimes you have to be in a good position, and it's important. You have to wait, right? It's kind of wait till you see the whites of their eyes, right? You have all sorts of military analogies about this,
Bring
where
it on.
timing is always important. You know, let the enemy really fall into the trap.
Right.
And so I think that you know, billions and billions of dollars are spent on advertising to try to get individuals to trade a whole lot, because obviously the industry makes money off of that. But
Right.
the industry's making money off that, not necessarily the individuals. And so
Right.
I think people need to ask themselves the fundamental question: am I an investor or am I a trader? And and if I really want to do trading because I have that need and that feel for that rush or whatever that is, then segregate the money you're trading with
There
and
you go.
go, this is what I'm going to trade with.
Right.
This this is my stay wealthy money. This is the money that's important for my children and my grandchildren.
Right.
And that's a very different time horizon. And I think that that's very important. People have to segregate that a little bit. And I think that generally will help them over time.
I think that
Because
is real.
I always ask the question, all right, what is it that you want this money to do? You know, so
Mhm.
and then work around that.
That is really, really good because almost you're protecting yourself from yourself. Because if it's all in one bucket or one basket, you're gonna, yeah, I get that. Really smart. Okay, next question. What is the best piece of advice you'd like to share with the audience or give your 30-year-old self?
I think going back to that analogy that I gave you, that God and nature are along. I mean, every things are set up in a way that if you allow the innovation of the American spirit and the capitalist system to work in a free society, and you pay attention to the big things that are pushing that around. You know, take a look at, I mean, if the government says they're going to spend a ton of money on something, probably the companies that control the choke point in that, like that's why we like infrastructure so much. We're spending $500 billion on roads and bridges, right? So the companies, there's only like 30 companies that do that, right? They're going to get a lot of money, right? So we like those, right? Or if you think about what drives human beings to do stuff, right? So if you think of Maslow's hierarchy of needs, we have
Please, yeah.
physiological needs and safety and security. Well, safety and security is you don't have to go any farther than the cell phone that's in your hand, right?
Right.
Why is that a big theme, right? And that is because that's how you dial 911. That's how
Right.
you contact the people they're doing. And if you've ever stopped the car and gone back to the house to pick up what you forgot, right? Welcome to your security blanket. And
Right.
so we look, just the timeless advice there for everyone is look for what 100 million people are doing, right? If I can tell you what 100 million people are going to do before they do it, do you think we can make some money? I mean, of
Know it.
course.
You
And
know it.
look for that. And if you and then also I think the other issue is people don't change very much.
Right.
We really don't. Why did the Romans have gladiators?
Yeah.
Because they didn't have the
Smart.
NFL. I mean,
Right.
and so
Exactly.
right.
Yeah.
So we think about what people are going to do and recognize that doesn't change that much, but the how changes, right?
Mhm.
When we
Mhm.
were little, we probably used a Sears and Roebuck Montgomery Ward catalog, right? And circled it for our parents, right? And
Yeah.
they bought us stuff for Christmas. Well,
Yeah.
now we're online and we're,
Yeah.
and instead of 4 to 6 weeks, it shows up in 4 to 6 hours. So
Right.
the what we did doesn't change, but the how. And so if you can get in front of a sea change of how,
Mhm.
you have tremendous opportunity for the future.
Yeah, that is next level awesome. Thank you so much. Before we wrap up, Dryden, you had mentioned you had some stories that you wanted to share and some lessons. Did you want me to touch on any of those, or did we cover them?
Well, I think the story about God is long is I think a really important one.
Okay.
I think that just recognizing that was a lesson. Similar lesson is you talk about fundamental and technical analysis is great, but that's not really how you win, right?
Right.
In the end, it's back to what human beings are going to do. So I think you have to be very careful about getting overly caught up in aspects of technical analysis because sometimes all the Greek letters are really just what people use as an excuse for their failures. And so I really think that it's important. The stories are around when we think about what's changing. So if you think about right now, if you took every structurally deficient bridge in America,
Mhm.
put them end to end, it would stretch from Seattle to Las Vegas, 1,100 miles.
Wow.
And so So my story is, if you go across a bridge, and you probably have, right? There's a
Yes.
big truck running beside you, and the whole thing's bouncing, right?
Yep.
And you're
Yep.
worried about that. It's scary. There's 45,000 deficient bridges. So the point of the matter is the story is that we have to fix those,
Understood.
and and Congress actually agrees on that one thing,
Right.
and so now we're doing that, and so get in front of that trend. So the story becomes, what are the things you have to do?
Got it. No, it's
Those are the things that you want to be important and have important in your portfolio.
I love it. Well, Dryden, thank you so much for coming on the show. What is the best way for people to get in touch with you? Or do you have a website that you'd like to share, or websites?
Sure. The easiest way is Dryden.Pence at lpl.com. That's very simple. My email is Dryden.Pence at lpl.com, and someone on my team will get back to you. And then our phone number is 949-660-8777. We have 3 websites, pencewealthmanagement.com. Pence Capital Management is for some of our UITs and products. We also have an ETF. And then Pence Financial Group is the entity that has offices throughout the nation, where we probably have someone in your local area that can help you with the things that we do and apply the principles that we have and help you with what's next.
I love that. Well, Dryden, thank you so much for coming on the show. This has been absolutely fantastic. And hopefully we'll have you on again soon.
I'd like
And
that very much. And we'll talk about Maslow's hierarchy of needs in your book at some point. That'd be fabulous.
so actually, you're going to laugh. I actually have an Adam's financial hierarchy of needs for people, which they go through, but we can discuss that another time.
God, I'd love it. That'd be fun.
Okay. Thank you.